Thank you very much. I'm trying to do this quickly and save minutes. First of all, I would like to say thank you to FIAP and Inverco for inviting me here. It's been very interesting, and we are really up to date now with the situation of pension funds around the world. It's challenging, and indeed, as Cesar Vallejo said, there are many things to be done in many areas because we are living in a globalized world, but it's heading in different directions. We are going to take a look at, well, things we've already discussed already today, things that have already been mentioned. We have the pension systems which are under pressure because the world population is aging, because there are mega trends in terms of work, the way people work, automation, we have self-employment, greater entrepreneurial approaches, and we have different realities. We have a world in which there is greater uncertainty, and it's harder and harder to get increased profitability, and we're heading towards a population of 2,000 people, the speaker says, of an elderly age. For pension funds, the problem is that we have a deficit in terms of the funds. We need to have more financing. And now we can reach $15 trillion in the Anglo-Saxon trillions, which we need to be able to finance pensions of the people who are going to be retired in the future. So if we want to increase the sources of funding, this is something that we have known is necessary for some time now, and I think we should accept mea culpa, above all in the case of Latin America. In the case of Europe, and we've seen the example of one of the best funds, the best according to Mercel last year, the one from Holland. They've been more proactive, and I think that in Latin America we have to accept our responsibility because the answers are out there, and we knew them. Greater coverage, increasing the retirement age, giving incentive for older people to continue working, increasing the framework, the legal institutional framework to favor an institutional framework which would not allow pension funds to be used for anything other than pensions. A high corporate governance standard. And there's another point here which is related to efficiency in our investments, greater profitability, whilst maintaining the established limited risk, and this forms part of this block in this seminar. And so we are talking about, and we've seen profitability metrics and risk metrics. We're talking about thematic investment. We've heard about target date funds. We've been talking about target risk funds, but why don't we try to look at this from a more integral perspective? How does efficient investment within an efficient pension system, how does this fit into what we have in the world today? And here I'm trying to find metrics to look at whether there exists a virtuous circle between the efficiency in the managing of a pension fund, not a system, because that's a different issue, with greater depth in the capital market and greater social well-being. And efficiency there, I think that we need to look at efficiency, social well-being, the depth of the capital market. But I don't think, as we've seen, That's times that these factors are opposing factors. I think that right now an overall view, an integrated view, can help to bring these three fields within society and economy together so that we can have this virtuous circle and we can strengthen it and it can feed itself. If we talk about the pension system, I used the Mercer ranking, as we heard before. I think it was published 2 days before this seminar. And the size of the funds compared to GDP of each country, and then also the Chilean case, to look at whether there are efficient portfolios. If we look at the depth, if we talk about the depth of the capital market, what we did was to study the Financial Development Index of the IMF to give us an idea of the depth of the market, and I've detailed what that's all about in greater detail, and also the stock market assets compared to GDP. And on the social side, we have the Human Development Index, poverty indicators, and the Gini, which is, well, maybe it's what best measures equity, the GINI. So we have this capital market, the idea of well-being, which is related to financial inclusion. We have these different variables and we can see how they are connected. So we have a virtuous cycle here. We have a pension system with many shortages and shortcomings. It needs changes. I think that there has been perhaps a lack of zeal on the part of the authorities and the companies and the private sector with regards to the idea that they haven't been as proactive as they should have been, as they have been in Europe. We could have individual capitalization, such as in Chile. This could be efficient or not. So we'll take a look at this. And here we're going to look at this situation. We have all of the asset groups in which Chilean pension funds can invest. And we have the efficiency frontier, which is between risk and profitability. So we have variable or fixed yield, local, international. And we worked with multi-funds, and indeed the multi-funds in Chile, with low contribution rates and whatever you might like, they are very close to this efficiency boundary. And this has been achieved thanks to diversification. Diversification provided by a really deep capital market. And this takes us back to that circle and takes us through to all of the asset groups. What would have happened if in Chile they had limited the investment, foreign investment?
We simulated that green line. That green line, there we limited the investment in equity, foreign equity, to 10% and fixed income 20%. What did it end up with? The same risk levels and lower return. So an efficient pension market, an efficient pension fund at investment level needs the widest diversity of assets. What happens if we do the opposite? We put in every fund a 10% in alternative assets, half of it private equity, half of it real estate. And with that, we were efficient. We have the same risk level and higher returns. And that way, if we include 20%, we have an even bigger potential for return. We're increasing the efficiency and profitability of pension funds as an important source of funding, which is one of the many things that pension systems need across the world today. We take it to 20%, even more. So let's leave it at that. An efficient portfolio of pension funds need a deep capital market that gives it access to international assets and that provides it with facilities for fund flows, everything related to settlement. So, what did we study? We took a country of each segment in Mercer index. And it's linked to these three areas: efficiency in portfolio management, social welfare, and debt of the capital market. These are the variables. More than half of the 18 variables used by Mercer are relevant in order to see if we generate this virtuous cycle. We take some countries from each segment in the ranking to do this study. What are our conclusions? This is like a first approach. We can have many other studies based on this. The best pension systems have deeper capital markets. That's intuitive. But where are we? Where's the second, third country with the best pension systems? You see them here. You see how they're doing. The best pension systems have deeper capital markets. That equals to a higher depth of the capital markets, this market cap on GDP. A deep capital markets gives diversity, etc. Usually, people talk aloud. There's a lot of academic research to see what comes first: economic growth, deep capital markets. There are different views on that, but they feed each other, and we see it here because the higher the debt, the bigger the size of the economy. Let's go to the other side. How do we relate two things that are very polarized in today's world? They're like in opposite situation. How does a deep capital market feed social welfare and the other way around? Let's see what happens. And we're going to put the 9 countries of Mercer index to consider these relations. First, a deep capital markets relates to a higher human capital. Here we are including the index of human capital. So higher welfare, capital markets are deeper, and social welfare is higher. And you see that in countries with the best pension systems. Let's go to the other side, lower poverty. This is the inverse poverty index. There's less poverty in countries with deeper capital markets and more equity. The Gini index is also inversed because the higher the Gini, the lower the equity. Let's take a look at financial inclusion. It combines capital market because there are a lot of people to offer products to, and it contributes to social welfare because people have access to cards, etc. The index of financial inclusion, or banking index, it's an index by the World Bank. It's very interesting because this year it includes fintech, mobile phones for transactions, not just for formal banking. It's a very comprehensive study. It's impressive. They also cover informal financial systems. And we see that the higher the banking degree is, you see that deeper, you see also deeper capital markets. So we've covered the capital markets debt, social welfare. This was the first approach to see where we are today. And as I was saying, there are many things many ways to see these. We can further study it, but I think it's good to know where we are and how can we study efficient management of pension funds, efficient pension systems with other aspects of the market that provide development potential for a country without forgetting about social welfare and how to communicate it. This is related to the previous presentation. It's not that easy. I think that communication, and since we've listened to Professor Moshe, we have to consider this from a logic perspective, how we provide more knowledge to people. How is social welfare related to better quality of pension system? Countries with the best pension systems have better quality of life. But it's intuitive, we want to see figures. Less poverty, more equity. And now let's study the size of pension funds. And when you take a look at the size of pension funds, after seeing what's going on in Peru, in Chile, where pension funds are being wasted, let's see the relative size of pension funds in countries, how important it is, and let's do studies beyond this, because this is just a first approach. We have to see how the size of a pension fund is critical for the quality of life of that country's population. Today, tomorrow, our children, some do better than others, but this is critical. This is what you see, the size of the pension fund, quality of life. Size of pension fund, poverty. Size of pension funds, equity. All of this, we're cutting it with withdrawals. We have this feeling of powerlessness. We need to continue to study this to convey the message. We have to see how we sort this out, and by assuming our guilt, because yes, we've been reactive. I think that in other countries, Anglo-Saxon countries, I don't know if it has to do with Protestantism, Catholicism, etc. They were proactive, and so they did something beforehand. We knew this. In Chile, we had recipes, but here we are. And now we're using an important part of the savings, and this is going to be sacrificed for people. The size of pension funds has to do with access by people to the financial system. That's something we are also sacrificing. In this sort of salad, I put return of pension funds. That return is the size of the ball. That ball is real profitability in the past 10 years of the selected pension funds. We have quality of life and depth of the capital markets. There's a relationship, apparently. You'll receive this presentation in a few days. You've seen the variables of the Mercer Index, the countries that we've taken from each segment. And here we wanted to add an additional variable, which creates these different balls of different colors with returns that usually see, for example, in the Netherlands, the real return of pension funds is 6.2%. Second in the ranking, Iceland is the first one. Australia is one of the first ones. It's also interesting. Canada, more than 5%. In Poland, there's been a lot of changes, so the situation is a bit distorted. In the case of Poland, there's just 5 years. In the case of Chile, this was very damaged recently due to risk, microsocial, economic, institutional risk, and we see a clear relationship. So without anything else, our conclusion here is that the virtuous cycle is there. wider the diversity of financial instruments, the more efficient pension funds are. We need a deep capital market to provide alternatives for investment opportunities. The death of the capital market contributes to the social welfare, and it's fed by it. And social welfare also fosters the growth of pension funds. It generates savings and allows us to achieve better pensions for everyone. That would be it.